Have you heard of the 1031 exchange? The process allows real estate investors to sell a rental property, upgrade to a better property, and defer tens of thousands of dollars in taxes. But the rules are strict, and one misstep can make the entire transaction taxable. I've been doing some research on the 1031 exchange in hopes of completing my first exchange soon. So today I'll share what I've learned about the process, the timeline, and the terminology. This is educational, not tax advice, but it will arm you with enough understanding to know what questions to ask when you're ready to do your own exchange. So what is a 1031 exchange? Let's go over some key points. 1031 exchange refers to IRS Section 1031, which goes over how to do a tax-deferred exchange. In real estate, you have a relinquished property, which is the property you're going to sell, and a replacement property, which is the property you're going to buy with the proceeds from that sale. And it's important to note that tax deferral that you get from the 1031 exchange is not a tax forgiveness. Eventually down the road, if you sell the property, whether it's the first property that you 1031 exchanged into or whether you've done it multiple times, the IRS will get their taxes unless you keep the property until you die and your heirs inherit it. A few more things to note about the 1031 exchange. It can only be used for investments and business property, and you must have the intent to hold it as an investment. So you're not going to be able to use this on primary residences or on flip properties. Those are personal and they're too short in the timeline. So primary residence and flips usually don't qualify. And you must plan to do the 1031 exchange before you close on the sale of a property. If you close on the sale of the property and then you start asking about a 1031 exchange, it's already too late. So before we dive in more to the timeline and process of a 1031 exchange, let's have an example exchange to look at. Let's say that you bought a duplex for $250,000. You put $50,000 down, so you have a $200,000 loan when you first close on that property. Over time, you enjoy loan pay down, rent increases, and you take depreciation on that property with your taxes each year. At the time of sale, you're able to sell this property for $400,000. That's great appreciation. And your remaining loan balance is now down to $150,000. You're gonna spend some money in closing costs, so let's say that's about $30,000 on the sale of this property. So a $400,000 sale minus a $150,000 loan payoff and minus $30,000 in closing costs leaves you with $220,000 in cash that you can use toward your next investment, assuming you don't have to have taxes taken out of it, and that's where the 1031 exchange comes in. If you plan ahead, that $220,000 can go to a qualified intermediary, and you never touch the money. This is what allows you to complete this exchange and not be taxed on that $220,000. A key term here is constructive receipt. If at any point before you buy your next property, you access those funds, the 1031 exchange falls through. You're not able to do it. All right, let's talk about your 1031 team. These are the key players that you need to properly execute a 1031 exchange. First of all is the qualified intermediary. You need to find one of these before you ever sell the relinquished property. The qualified intermediary is a required third party. They will hold your funds for you in escrow while you identify your next property and close on it, and they will prepare the exchange documents that you need. On top of that, you're going to want to work with a CPA or some sort of tax advisor to help you with a couple things. First of all, they're going to help you confirm eligibility. You need to know that the property that you're about to sell is actually eligible for a 1031 exchange. They can also help you model your tax exposure. So they can look at how much tax you would pay if you just sold it without a 1031 exchange versus what's going to happen when you do sell it in a 1031 exchange, and make sure that it's actually worth going through that 1031 exchange process. At the end of this video, I'll explain some scenarios that might make it not necessary for you to do a 1031 exchange. And finally, your real estate agent and lender. They need to understand the timeline associated with a 1031 exchange so they can best support you in the process, because as I said at the beginning of this video, the process and the rules are really strict. So if you misstep along the way, or if you don't do everything in the timeline specified, you're not going to be able to take advantage of these deferred taxes. All right, finally, it's time to get into the 1031 timeline and process. Step 1, pre-sale planning. Before you even sell your property, a few things that you need to do. First of all, reach out to your CPA to model the tax situation and determine, is a 1031 exchange even right for what you need right now? Determine if the 1031 exchange actually fits your goals. If it does, make sure that your property actually qualifies for the 1031 exchange. And then finally, it's time to find your qualified intermediary. You need to engage with them before you sell the property. As I said before, if you close first and ask later, it's already too late. Step 2 is the 45-day identification period. Your 45-day identification period starts the day after you close on your relinquished property. This is 45 calendar days, so weekend and holidays do count. You must identify your replacement property or properties in writing in the proper way pay during this time frame. And you can work with your qualified intermediary to make sure you're doing it the right way. The IRS gives 3 different ways that you can identify replacement properties during that 45-day period. The most common is the 3-property rule. You can list up to 3 properties, and it doesn't matter how much they cost. Most investors use the 3-property rule because it's the simplest. For instance, you might identify a 6-unit apartment building, a mixed-use building, or a portfolio of duplexes. And as long as you end up closing on at least one of those and it fits the other criteria by the end of the total 180-day period, then you're good. If you want to list more than 3 potential properties, you can, but you have to use what is called the 200% rule. This is usually used when an investor is trying to use up all the money that they need to in that 1031 exchange by cobbling together a whole bunch of smaller properties. Maybe they can't identify a larger property that takes up all the money that they have to use, so they need more than 3 to do it. Now, the trick here is that you can identify more than 3 properties, but the total value of all those properties cannot be more than 200% of the value of the relinquished property. There's a third option called the 95% rule, but it's basically a last resort. If you identify too many properties and you go over the allowed value, you have to actually buy 95% of what you identified, which can be kind of tricky. So these 3 rules, as you can tell, get a little bit confusing. Most people do stick to just identifying 3 properties that would fit the bill for their 1031 exchange and leaving it at that. But I wanted to let you know that there are a couple other options which you can speak with your qualified intermediary about if it does come down to that. Step 3 is the 180-day exchange period. So this means that from the day that you close on your relinquished property to the day that you close on the replacement property or properties can only be 180 days total. That's 180 calendar days, and it does include the 45-day identification period that we just talked about. And there are no extensions to this, even for financing delays. So let's talk about what is the right replacement property to satisfy the IRS requirements. There are 3 key rules here. First of all, you must buy a property with equal or greater value than the property that you sold. Next, you need to reinvest all net proceeds from the previous sale. If you don't reinvest all of it, you will be taxed on some portion of it. And finally, your new debt amount has to be equal or greater than the debt you had on the previous property. So going back to our example, you were selling a property that was worth $400,000 at the time of sale, and you had $150,000 in debt on that property and $220,000 to reinvest. Let's say your replacement property is worth $650,000. That is equal or greater than the $400,000 property you just sold, check. And you are able to put down all of the $220,000 that you got out of your previous property, check. This leaves you with a loan of $430,000, which is obviously greater than the loan of $150,000 you had on the last property, check. You have satisfied all the IRS requirements with this one property. As I said earlier, you can do it with more than one property. Just make sure you're following all the rules in how you identify them and how many properties there are so that the IRS will accept your replacement properties. A key note here is that the IRS does not actually care about the loan to value. They care about the actual debt amount, the dollar amount of your debt. So it's not a question of loan to value. It's a question of how much did you have in debt previously? $150,000? Okay, that's what you need in debt at least on your new property. All right, let's define boot. This is a term used when you either don't fully use all of your funds from your previous property or you're not able to match the amount of debt you had previously. So cash boot is when cash is taken out. Maybe in order to buy the new property and have that $150,000 loan at least on the property, you are only able to put $200,000 down on the property. That leaves you with $20,000 of cash boot that can be taxed. On the flip side of that, maybe you are able to put all of your $220,000 down on a property, but you're left with a little less than $150,000 on the loan. Let's say it's $100,000. That $50,000 difference in your debt on the new property is called mortgage boot, and that is also taxable. So if you're not able to fully satisfy the cash reinvestment or the loan amount, you have boot, and that does lead to some taxation, but it's probably not as much as you would have been taxed if you didn't do the 1031 exchange at all. So maybe you're listening to all this and thinking, Megan, why would I ever want to do a 1031 exchange? It sounds like such a pain in the butt. But here's why investors do it. When you sell a property and you have $220,000 in cash coming out of that property, there can be some big taxes on that. And that really cuts down on how much of that money you can put into future investments. So a 1031 exchange preserves more of your capital, almost all of it, to go into your next investment. It gives you greater buying power for a bigger next deal, and it helps investors to scale over time. But yes, it is a tricky process. So let's go over the top most common 1031 mistakes that investors make. First of all is waiting until after closing. This completely negates your ability to do a 1031 exchange. You have to start the process before you close on the sale of your original property. Missing deadlines or improper identification of the replacement property also messes up the process. Touching your funds obviously messes up the process, or maybe you just have a portion of the funds come to you and that reduces how much tax savings you get. Not appropriately planning your debt replacement can also lead to some taxation. And poor lender coordination can really mess with your timeline. If your lender is not able to help you close before the 180-day period is over, you could completely miss the opportunity to do the exchange. So when does this crazy process of a 1031 exchange make sense? If you're planning on staying invested in the real estate market, if you're trying to scale up or reposition your portfolio, and if the taxes that you have to pay on a sale would drastically reduce your buying power, then a 1031 exchange makes sense. However, it might not make sense for you. If you want to cash out and leave real estate, it doesn't make sense. You have to only buy like-kind properties, which means you can't cash out of real estate and buy a business in a 1031 exchange. It has to be other types of real estate. So if you're getting out of the real estate game, a 1031 exchange won't work. If your gains on a sale are minimal, it probably isn't worth the 1031 exchange either. You might not actually have that much tax to pay, and this is why you talk to a CPA before you even start the process to understand if you really have that much to mitigate. And finally, if you think the timeline pressure is just way too risky, it's probably not worth going through the process. Again, talking to your CPA, to your agent, your lender, and a qualified intermediary can help you decide if it makes sense and if the timeline will work in your favor. I hope this explanation of the 1031 exchange has you thinking about some smart, tax-efficient ways to continue to build your portfolio over time. As always, let us know in the comments if you have questions or if there's anything we can clarify for you. Please like, subscribe, and share this video with any fellow investors or aspiring investors. But most importantly, keep learning, keep growing, and have fun.